If you've ever felt like investing is this super complicated, risky thing that's only for people with finance degrees, then you've come to the right place. We're about to break down a really simple, step-by-step plan to get you started on your investment journey, completely from scratch.
And yeah, it's a totally normal feeling. You hear all the time that you should be investing, right? But there's just so much information out there, it can cause this analysis paralysis, where you're so overwhelmed you just end up doing nothing. Well, today we're going to cut right through all that noise and give you a clear, actionable plan.
But before we even get to the investing part, let's start with a number that's, well, it's kind of scary actually. Nearly 40% of adults can't even cover a $400 emergency without borrowing money. Now, why does this matter for investing? Because it is the number one reason people are forced to sell their investments at the absolute worst time. So before we even think about stocks, we have to build a solid financial base first. And that brings us to our very first phase. Now, this isn't about delaying your investing journey. Think of it more like completing level 1 of your wealth building plan. This is all about making sure you can invest with confidence, knowing that a flat tire or a broken down furnace isn't going to completely derail your entire future.
I love this analogy. Just picture it. The water you're pouring in, that's your money. The bottle is your investment account. And that big hole at the bottom, that's your high-interest debt, like a credit card. You can keep pouring money in, but you're losing it through that hole way faster than your investments could ever hope to grow. It's a losing game right from the start.
Let's just look at the simple math here. Credit card debt can have interest rates of like 20, 30, even 40%. Paying that off gives you a guaranteed return of that much. Meanwhile, the stock market averages around 8 to 10% a year. So here's the key takeaway. Paying off your high-interest debt is the highest return, lowest risk investment you will ever make, period.
So, to recap this whole first section, your mission is pretty simple. First, you've got to eliminate that high-interest debt. Second, build up an emergency fund with 3 to 6 months of your essential living expenses and keep it somewhere you can get to it easily, like a savings account. And third, just be really clear with yourself that you're investing for the long haul, for goals that are at least 5 years down the road. Once you've checked those 3 boxes, you are ready to really start building wealth.
All right, let's move on to the action. With your foundation totally secure, it's time to actually start. And this right here is where most people get stuck. But you know what? It's surprisingly simple if you know the secret.
And the secret is just this. You do not need to be an expert. You don't need to predict the future. You literally just need to take that first step of opening an investment account, which, by the way, you can do from your phone in like 10 minutes. Honestly, taking that one small action is 90% of the battle.
Because once you start, this is where the magic really happens. We're talking about compound interest. It's the engine of all wealth creation. The best way to think about it is like a tiny snowball at the very top of a really long hill. As it starts to roll, it picks up more snow and it gets bigger and bigger and faster, all on its own. Your money works the exact same way.
And you can see the power of that snowball effect right here. If you invested just $100 a month, after 30 years, you'd have over $140,000. But here's the incredible part. You only actually put in $36,000 of your own money. The other 100 grand plus, that's pure profit generated by your money working for you. This is why starting early, even with tiny amounts, is just so unbelievably powerful.
Okay, so what should you actually invest in? The key principle here is something called diversification. You know, you wouldn't eat a plate of only pasta for every single meal, right? You need a mix of stuff. Investing is the same exact thing. You don't want to bet your entire future on just one single company.
And for a beginner, there is no better, simpler tool for this than an index fund. See, instead of trying to pick the one winning company out of thousands, an index fund just lets you buy a tiny little slice of the entire market, like the 500 biggest companies in the US, all in one simple low-cost package. So what this really means is that index funds solve all the major headaches for new investors. They give you instant diversification, they're incredibly cheap, and they let you benefit from the growth of the whole economy instead of guessing which stocks are going to win. It is the perfect set-it-and-forget-it starting point.
Okay, so you've built your foundation. You've started investing simply. Now it's time for the final and maybe the most important phase of all. From here on out, your success is less about what you do and a whole lot more about what you don't do.
Now this sounds completely backwards, I know, but it's the absolute truth. The more you tinker with your portfolio, the more you check it, the more you react to those scary news headlines, the more likely you are to make emotional mistakes that will kill your long-term returns.
This might sound like a joke, but it's a real finding from a famous study by Fidelity. The investors who did the best over time were either, well, they were deceased, or they had just forgotten they even had the accounts. And why? Because they literally couldn't mess with their own investments. It proves a really powerful point. A lot of the time, your own behavior is the biggest threat to your success.
So how do you protect yourself from yourself? You automate. You set up an automatic transfer from your bank account to your investment account every single month right after you get paid. This takes willpower and emotion completely out of the equation. The system just works for you, humming along in the background.
Now, at some point, the market will drop. It's going to feel scary. This number, 19, is the number of major stock market crashes over the last 150 years. They are a normal, inevitable part of this whole process, but what really matters is what happens next.
This is probably the single most important message to remember. Every single crash, from the Great Depression to the dot-com bubble to the COVID crash, every single one has been followed by a recovery and then a climb to brand new heights. The market rewards patience, not panic. Your job during a downturn is to just stay calm and stick to the plan.
So, let's bring this all together into a final playbook, shall we? Building wealth isn't about some complex secret strategy. It's about following a simple, repeatable process with a little bit of discipline. So first, you build that unshakable financial foundation. Clear the debt, save for emergencies. Second, you start investing simply and consistently, using those low-cost index funds. And third, you master the long game by automating the whole process and learning to stay calm during the inevitable market storms. That's it. That's the entire playbook.
The journey to financial freedom is really just built on small, consistent actions. It's not about being a genius, it's about just getting started. So my final question to you is this. 10 years from now, are you going to be looking back at the wealth you've built, or are you going to be wishing you had just taken that one small step that you can take today?